Hello, everyone, and welcome to the webinar. I'm Nick Zulovich, part of the team at Cherokee Media Group and senior editor of Subprime Auto Finance News. We're so appreciative you've joined us for our session entitled Risk 360, Connecting Refunds, Recovery, and Portfolio Resilience. Thank you again for joining us. Refunds are in the regulatory spotlight, but they're only one piece of the compliance and recovery equation. For lenders, ensuring accurate, timely refunds are both a regulatory mandate and a reputational test. Yet refund challenges often expose broader portfolio risks, from higher borrower payments and repossessions to uninsured vehicles and early loan terminations. So in this session, we have two distinguished executives from Allied Solutions, John Elias and Peter Kroll, who will explore why refunds matter now more than ever and how leading lenders are using them as a catalyst to strengthen compliance, protect portfolios, and build operational resilience. So let's all learn how a life cycle-based approach turns refund obligations into a strategic advantage. So without further ado, please welcome John Elias and Peter Kroll with Allied Solutions.
Thanks, Nick. Yeah, appreciate the opportunity to partner with you as always. Really enjoy these types of opportunities, and we certainly look forward to seeing a lot of you at Used Car Week coming up next month in Las Vegas, Nevada. So I'm Peter Kroll along with John Elias, and we're happy to be talking to you today about a lot of not just refunds, right? The overall, like we talked about earlier too in our prior sessions, what starts with the refund doesn't always end with the refund. So when you look at that 360-degree picture of auto risk performance, originations, and the servicing of those loans throughout the entirety of that life cycle, John, it's getting longer, and I would say incumbently, there's more risk.
Yeah, again, I would also like to say hi to Nick and thank him so much for this opportunity to get back in front of this group, and the folks that are listening, thank you for joining us today. Yeah, it's a little bit of a story of canaries and coal mines, Peter, right? I mean, there's a lot going on. Things have changed even since we had last had an opportunity to meet with Nick. We've expanded our suite of solutions, right? So it's mentioned a little bit earlier, reactive and proactive. We want to share with you some of the observations we see in the industry, some of the observations and some of the anecdotal feedback we've received from our lenders and current clients. We also would like to share with you a little bit more about what does it mean from a soup to nuts type of ecosystem that Allied has invested in. It's intentional, our investments, and we're really moving more into the technology, which is just incredibly exciting as we look forward to it.
Yeah, it sure is. Well said, John. And really that 360-degree view, it can't be done without technology.
No.
So whether it's AI, whether it's investments into APIs, whether it's plug and play with different ways to help you manage that risk in your auto loan portfolio, just know that that's a continual investment we're making on your behalf. It is not a singular event in auto loan servicing. It is understanding the stakes around the totality of that entire life cycle.
Yeah, and if you're looking at a 3 to 5% cost for servicing, that's really where we would like to have a conversation with the audience and give them an opportunity to kind of listen to and see how we're structuring our solution sets. So where do you want to start off, at the borrower risks?
Yeah, absolutely. What are people paying for new cars today, John?
You know, I looked at some recent funding data as of September. I think 20% of people had a payment over $1,000 per month. 22% of that population had loan terms in excess of 7 years.
7 years.
$46,000 is the average. But really, what does that story tell you? It tells you that the consumer is using every tool that's available to them today to try to get the affordability of these new vehicles or these used vehicles or these CPO vehicles in a range where they can actually purchase them.
Right, yeah, and you know, all the different sectors that are involved in auto loan originations, servicing, banks, credit unions, finance companies, captives, OEMs, they're all coming up with creative ways to ensure that the vehicle remains affordable, right? And so with that, to your point, John, too, 96-month loan terms, right? And that risk to the borrower in terms of the depreciation alone after year 3, after year 4, How many of these borrowers, John, do you think are actually going to hang on to the car for 9 years?
What did we see? I mean, the latest stats showed us that ownership had moved up a little bit. The life cycle of it moved maybe
Yeah.
3 months additional, and then what had been the norm. The real difference here is it's a whole different picture being 3.5 years into a loan on a 60-month note compared to a 96-month note, to an 84-month note, especially in those cases or in those circumstances where potentially you've paid sticker or above sticker for the vehicle. You've rolled in negative equity because, as we see in the recovery risk, the auction shortfalls, we're seeing that these vehicle valuations are fluctuating. I mean, anyone out there in the audience that's looking at their carrying cost for repossession should see that between $35 to $70 per day is the cost of them before they can get that vehicle liquidated.
Right. Yeah. So that the risk is starting to, from that 360 perspective, is starting to broaden out over longer periods of time at higher costs.
Yep. And then, of course, you have the industry, which went during COVID when a lot of these industries were shut down. There was forbearance, right? Lenders were trying to help the consumers during this difficult time of the pandemic. Many of the companies that go out there and recall these vehicles or search for these vehicles, many of them went out of business. So you have a limited number of options now that you have available to you as you're seeing this other side of the loan equation begin to tick up.
Yeah, big time. It went from incredibly quiet when nobody was doing anything in COVID to a very noisy and getting louder environment now. So that's a great point, John.
Yep. So maybe what we do is we'll jump into the next slide, and we can lead it off here, Peter, or I can lead it off and just speak a little bit about portfolio risk, those aging assets,
Yeah,
right?
exactly.
So you have these assets that are sitting out there 8 years. I've seen some at 9 years. It gets a little scary, but when you're attempting to finance a $50,000, $60,000, $70,000 vehicle and you're attempting to get to a certain payment range, the only alternative really is to extend out the term because the main cost, vehicles have gone up a little bit due to tariffs, but the real cost right now is in the interest rate.
Oh, big time, right? And you raise a great point there when you start looking at the portfolio risks and the compliance risks. Even though we can factually say, right, we're now in a declining rate environment, at least the start of it, you are going to see so many of these refinances happen, right? Which in and of itself means that you as the auto loan servicer, as you well know, you have some responsibilities around what we would call a triggering event for these early loan pays. And certainly too, John, you raised a great point I didn't want to lose sight of was the ROs, the repair orders that are coming in on these collaterals, on these vehicles that borrowers are hanging on to longer. So couple that with maybe refinancing on the same collateral 2 or 3 times over 5 or 6 years, and you do have some risk.
My gosh, repair orders, I think they averaged $4,700 last month.
$4,700.
So, I'm sure dealerships are looking at that pen rate for VSC contracts. That screams VSC contracts, which is interesting too. Another stat that I found interesting was the time it takes for a car in shop moved from 13 days to 17 days. And you're asking, well, why is that? Well, it's because of all these different components that are sitting in the vehicles today. They require calibrations. Right? So this car is sitting longer, so insurance is paying a little longer for a rental car in some cases. That's hence you're seeing insurance rates go up.
Yep.
Vehicle values are up, exposure's up, repairs are more expensive, parts are more expensive. So this is becoming kind of a lot of headwinds for the consumer to face today.
Yeah, I mean, you don't have to be in an accident for your insurance rates to go up, right? And what you just outlined, I think the broader market sometimes isn't quite aware of, okay, if the ROs are going up, the repair orders, like you said, a loaner vehicle is taking a while longer.
That's right.
And somebody's got to pay for all of that, right? And so when you look at this risk on a 360-degree perspective, again, beyond a refund, beyond what we'd call a triggering event within that risk being the retail installment sales contract, the risk within the risk, you also have to look at that from the perspective of how much exposure do you have on that portfolio then? And
right.
What were we talking about just this morning too, John, in some of our sessions here? There was some insights relative to insurance lapsing and the different predictive analytics. And I know you've been doing some work in this space, John, relative to early indicators for skips and pre-skips.
Yeah, it's really an interesting space. I mean, first thing I wanted to do is just share a quick stat too. Is 70% of total loss vehicles were 7 to 10 years old. So that's again telling us that consumers are holding on to cars longer. These things are aging. There is no manufacturer warranty that's available, and if there's no warranty in general for them to be able to exercise or any protections they can exercise, what do you run into, right? Something has to give. And many times what we're seeing is the first place you see the consumer pull back on, or the customer, would be insurance.
Mm-hmm.
First things first, I mean, a lot of folks went out there and acquired EVs. Those are still an expensive product. I think you're going to be surprised when you see your insurance bill for those products. So that wasn't necessarily factored in at the time of purchase, but now it's factored in as part of your total cost of ownership. And if that cost of ownership reaches a certain threshold, obviously something has to give. If insurance is the piece that's giving, as I mentioned about the total losses and the accidents, in many cases, when you're going to repossess that car or locate that car, it may have damage on it that you didn't expect.
Yep.
And to your point, that insurance, that customer going in and out of insurance coverage, or underinsuring, meaning that mainly they only have liability.
Yep.
Or unfortunately, what they may have done is move their deductible to a point where they don't have the liquidity to cover it,
Mm-hmm.
which is another scenario that we've seen quite a bit.
Absolutely. Yeah, great points there, John. And again, when you're looking at that whole 360, and again, a shout out to Nick and the crew for Used Car Week when it comes to these delinquencies, these repo assignments. There's going to be a lot of activity on the floor at Used Car Week next month, to be sure. But just in summary, for a lot of the things we've been discussing here, as you can see on the slides too, the rising portfolio risks. We have the 32.6% of trade-ins owe $5,000 to $10,000. Now, we say, it's a good time to buy gap insurance, right? When it comes to, or a gap waiver, because of how upside down some of these loans are going to become. And that stat says it all. There's other things to consider, the depreciation protection waivers.
That's right.
Looking at that originations and protecting the borrower, maintaining affordability for that borrower, these are great stats over 10 years of things to consider. I guess they're somewhat self-evident, but when you see the percentages on screen, they do make me want to take a little sip of water.
I really think that's just, I don't know if anyone can really accurately tell us where the economy sits today, right? We have a blazing hot stock market. We have inflation that still is not at the Fed target. It's easing.
Yep.
But it's not exactly where we want it to be, yet rates are beginning to drop. And then if you look at the labor market, that's telling us a little bit of a different story.
It is.
So there's a little bit of concern out there. Many times in the conversations we've had with our partners, it's been really the economy can go one way or the other. It's continue could take off, or we could see a recession creep in.
Yeah. It seems like uncertainty continues to be the only certainty, right? And in this ecosystem, the recovery ecosystem, you already highlighted so many of these things, John, but as an auto loan servicer, the physical damage claims, the total loss claims, gap claims, how long is it taking lenders today just to file gap claims and stay on top of those?
That's right.
What about all the paperwork that goes into those gap claims, the police reports, average turn times, and some lenders we've heard from, it might take longer than 60 or 90 days, and suddenly you're outside of the window of the time frame needed to get it all wrapped up and at least submitted for adjudication. And certainly cancellations, refunds, the delinquency and the repossessions, and the remarketing of collateral. This ecosystem for Allied is what we are expanding each and every day in order to kind of help you manage that risk, because it is truly, I think you raised it, John, like, give us the forecast on new car sales, give us the forecast on the economy. And everyone just kind of maybe is in agreement that there's a lot of things for us to keep our eyes on.
And how do I scale for that?
Right.
What investments do I make? Obviously AI has a low cost of entry. However, AI takes a tremendous amount of time to train to solve the problems you're looking for it to train, right? So what do I do in these circumstances where I'm uncertain as well as to how do I continue with my current staffing size?
Yep.
How do I keep my cost under control? And how do I manage all of these different events that are going on around me?
Yeah, exactly. Yeah, and here on the screen we have a little bit of the power of predictive data, and that's certainly something Allied has made a large investment in as well. And there's these leading indicators, again, whether it's insurance lapsing, these things that can, ultimately help I think you as the lender manage that risk. Another piece of this, and we didn't have as much about this because of where we are regulatorily, but it's not going away, right?
Right.
When we start thinking of UDAPs, the unfair, deceptive, abusive acts and practices, whether it's the FTC having that as a priority, which we know dealers have faced and continue to face, whereas the lenders now are kind of saying, hey, what can we do to work better with you dealers in order to make sure that what we're funding is exactly what we're supposed to be expecting through the servicing of that collateral type through the entirety of the loan. It's important to know what you fund, and it's important within those predictive data elements and everything else when it comes into how the states are looking at this versus, say, just the CFPB on the federal level. Things have changed a lot, and I don't know, John, would you rather have 35 different rules and regs under each state, or one mandate on whether it's refunds or timeframes relative to liquidation and things of that nature? It's an evolving landscape
Plus
as
and
well.
minus
Yeah,
50
right.
each, right?
Yeah,
I mean,
you got it.
You know, California obviously went and pursued their own CARS Act.
That's right. Yeah.
And when you talk in that last slide very quickly too, it spoke about poor data. And recently, as dealerships are moving to CDPs and these customer data platforms, they're realizing that they have about 48% bad data is currently residing in the system.
Yeah.
So think of that as you're looking at funding packages, and is the data matching on every single document? Really thinking of, for these protection products, those contracts, those gap waivers, those VSCs, those tire wheel contracts, does it have the right customer? Does it have the right customer address? Does it have the right collateral?
Right.
The 48% of the data is not good, so currently sitting in these platforms, it's passing on to you.
Yeah. And you raise a really good point there too. That's not part of the slide, but a couple of headlines in the news. This week we had a rather large bank acquisition going on, and this uptick of M&A. Again, some of the things we were discussing this morning. You're going to have a 9-year car loan, and what are the chances of some type of servicing or M&A happening within that institution over 9 years? To your point, John, what about all of the technicalities in that then when it comes to updating all of the information incumbent within that imaged database and lien holder agreements and the product contracts and updating lien holders accordingly?
Yeah, when do these mistakes surface? It's when delinquencies are up 40% and you're recalling the entire loan package and you're going through the documentation, and then you're finding the discrepancies. And then you're attempting to file for refunds, or you're attempting to exercise a coverage only to have that coverage denied. Why? Because it didn't represent the right collateral, the right customer wasn't listed, there's conflicting data. So again, when you see the delinquencies rising, the repossessions rising, collision claims, fascinating stat with what we see, right? 29% resulted in total losses. Gap claims versus refund, that's something I know that you've really taken on.
Yeah, we've talked about that quite a bit, and we have a stat under that reflects 15% trigger refunds within 1.4 years, meaning we will see a gap claim in about a year and a half, 1.4. But when gap is sold and amortized over a 9-year loan, the liability exists for 9 years.
Yeah.
And so you can generate your own amortization schedule around that, kind of make those determinations. But how does that account for skips within a portfolio? Again, in this 360-degree environment we're in, having those predictive analytics and a real-time look into the payments that have come in, whether they're delinquent or whether somebody was making an extra payment now and then, that has to be accurately reflected in order to make that determination for gap claim versus refund. And again, that's something we can help with.
And gap refunds are material. The cost of gap, if nobody's aware of it or hasn't been paying attention to it, has gone up quite a bit. Obviously, the assets have gone up. There's also been a lot of claim activity, right? So these gap organizations are under pressure.
Yeah.
And obviously the dealership back end, the front end is shrinking, margins are compressing. So they're going to the back end to write more of this product. So these products are going to continue into the future. In fact, I would guesstimate that they're going to increase in the number of products, in the creativity of the way they're going to bundle these products, and the protections that they're ultimately going to offer to the customer.
Big time. Yeah. Product innovation, I think, is going to not only be a part of that future, it's going to be part of our DNA too when it comes to whether it's a vehicle services contract, tire and wheel, a roadside program. The insurance side, like you talked about, John, gap, depreciation protection, bundled up in a way that is customizable for that lender and the borrower at the right time.
I think there'll be more guardrails too.
Totally.
I think they'll cap out LTVs.
Yes.
I think you'll see the reemergence of some stricter rules within these contracts, which is really going to require our financial partners to begin understanding what are my customers purchasing, what are my dealers selling.
Yeah, it's kind of exciting because product evolution can follow some of these uncertainties, and that helps right across the board for the origination side and the servicing side, having less UDAP. So with the right disclosures and the right products at the right time, rightly priced, regulatorily or otherwise, meaning a state statute can predetermine what you can sell some of these products for. It might be, more benevolent to have something that actually fits that borrower at the right time.
Yeah, and over the course of time, as that customer is maturing throughout the loan life cycle, because what we'd like to do is we'd like to offer our clients the ability to say, what is my refund liability? So give me some scenarios. A high, let's say that rates go down 150 basis points.
Yep.
And let's say the typical runoff is 3% of my portfolio due to early payoff, maybe perhaps for refinance. That doubles to 6% now, right?
Big time.
That's it. That's something to be aware of, especially if we do see that kind of movement by the Fed. I think it'd be important to get in front of that. In addition to that, we also want to give you some of these other leading indicators. As you mentioned, insurance is one of them. But we also want to give you indicators of, is the consumer proactively canceling these products because they are preparing themselves for some type of next step?
Yeah.
Perhaps they're currently speaking to a refinance lender and they're being asked to cancel all of their products because in the new loan, they're going to rewrite the products.
Yep.
Perhaps the customer is in financial distress, so they're thinking that if they cancel these products, the money will come directly to them and provide them some monthly relief, right?
Yep.
Unknowing that money should and probably will go back to the financial institution because it was really financed as part of that loan and it will help reduce the balance.
Yep.
So those types of things can feed into your modeling of, do I have a customer that's coming into market that I need to contact? Because maybe I want to reach out to them. It's what we call a response opportunity, where you can proactively reach out to the customer and say, we have maybe an offer for you or something for consideration. But we also want to let you know that, hey, this customer may be showing signs of financial distress, their insurance is lapsing. If you plug this into your probability of delinquency or probability of default modeling, it's probably going to give you a better idea of where that customer sits in repayment.
Right. So why wait for the rule book? You don't have to.
Yep.
You can create a playbook instead of a rule book.
Yep.
So I think everything you said turns into a playbook for a successful management of those originations and servicing.
We wanted to take the recovery side of the business and the experience that we have and help push that upstream into the origination so that our clients, our partners are making better decisions, timely decisions. More importantly, they're able to help get in front of that customer when the customer needs help, but may just be maybe a little reticent to ask.
Right. Yep. Yeah, and you said it best here, John. We've seen this for a while. Know that, at Allied we serve both as a GAP administrator and as someone who distributes GAP. We know GAP kind of inside and out from bundling approaches with various products, and we know the basics when it comes to the frequency and severity. We're hopeful, right, that we can start to see some stabilization around some of this. Relative to the long-range forecast, because everybody has had to make gap pricing adjustments in this marketplace. The frequency that we've seen, going up double digits. Severity was up 86%, I want to say, and that whole negative equity gap that we've already talked about, pun intended, is growing and growing and growing. So. Yeah, there's a lot there. So
I think it's a great time to actually look at CPI. I think it's a great time to look at depreciation protection, right?
Big time.
If the story right there is what we're seeing in GAP, then it's possibly the right time to look at these additional products.
Yeah, great point, John. That is like from the playbook to the rule book to a playbook. Now how to be proactive in what you as an auto loan servicer need to know. The deficiency balances we know are mounting. GAP, just as you said, John, partial solution. Claim severity, we said, is rising. We all know that. And refinancing is both that risk and that opportunity. There does exist in the turmoils of the markets in regard to tariffs, inflation, affordability, this opportunity to take what you're doing and make it better. And that's really, truly, I think, something when you look at this again from that 360 perspective, it can't be singularly focused. We know that.
Yeah, I think if I have a good solid balance in my portfolio, the last thing I want to see happen is my good customers refinancing out of my organization and offsetting the ratios within my portfolio.
Bingo, right? So how can we be proactive around that? We've talked a little bit about predictive analytics, the strategic partnerships, accuracy, compliance, portfolio-wide visibility. Refunds matter. Of course they matter. If a borrower is not thinking they're going to get a refund, except when they trade in their vehicle and then get one to help them with their budgets and their down payment, this is an opportunity for many lenders that both do direct lending and indirect lending. Just as you said, John, you got these indirect members that they may refi away from you.
Mm-hmm.
So there's tools, there's strategies, there's things we'd love to talk to you about that can help turn an indirect member, basically an indirect borrower, right into somebody who's going to want to do business with you at a financial institution because you understood those triggers.
And build share a wallet, right? I think that's really what our credit union partners in particular are looking for, right? They're member acquisition, member retention. So obviously be proactive as it relates to refinancing.
Yep.
There are certain indicators that you will see. There are triggering events as the customers positions themselves for refinancing. One other thing that I heard today I thought was really interesting, and it speaks to strategic partnerships, is our ability with some of our partnerships and our investments to have greater access to things like impound lots and storage lots, right?
Exactly.
This is a huge issue for
Big
our
time.
partners because these folks just don't want to speak to financial institutions
Right.
or negotiate with them in the proper way.
Yes.
So with our partnerships, we now have greater access into there. We have an actual player that sits within their space
Yep.
that they're speaking the same language with.
Yeah.
So that, to me, and some of the other partnerships that we discussed today, just amazing, really.
Yes, I agree. Yeah. If you want to be able to look at how to avoid the pre-skip, right?
Yeah.
We are, again, those investments I think are going to help you manage that risk appropriately. I think we have some time for some questions too, as we're getting ready to wrap here. And certainly for all of you, just, feel free to use your QR codes or your phones to grab a QR code there for John or I. Happy to sit down and have a discussion either live and in person at Used Car Week, or certainly anytime that you'd like to as well. So.
All right, we have had a few questions come in throughout the course of this webinar. So thank you again, Peter and John, for the engaging discussion that we've had. We'll take as many of these questions as we can. The first one that we'll go through is, how do you determine what is better for a borrower, a gap refund or a gap claim?
Yeah, we've had this one a couple of times. It's not just running an amortization schedule. It does start there. It may not end there. Right? And like John was talking about, when it comes to those predictive analytics, there might be some things you need to look in there relative to skips, extended pays, anything else that's happened in an actual payment schedule is really the way to make that best determination accurately, because the settlement is always going to be a little bit of a variable if you don't have any of that.
Yeah, that's absolutely right. I mean, ensure that the dealerships can write these contracts in many different ways. So making some broad assumptions and using some generic calculations will not point you in the right direction.
Right. Yep.
All right, great. Thank you both for that. We had this question I think is very interesting, and I can see this being a sticky topic. What state laws must be followed if a customer purchases a car in one state but resides in a different state?
Sure. Yeah. It's where you purchase the car. Those are the contracts that you're signing at the dealership that were filed and approved by the administrators, where the dealership is acting as an agent to sell that particular gap waiver in the state that you purchase. That's the easiest way to look at it. But John, I know there's always some nebulousness there, right, when it comes to Carvana and other things where you're purchasing maybe out of state, but you're actually purchasing it in state. There's a lot of things to consider there.
It's one of those things where I think of it in terms of where is this form approved and filed within the Department of Insurance, and what state is that form filed in, right?
Yep.
Because it's approved for that state. A form that's approved for Indiana may not be approved for Ohio. I live in Ohio. I could easily, on my way here to Carmel, purchase a car.
Yeah.
By the way, I'm not in market yet. I'm waiting for those perfect conditions. My car's paid off, so I probably will wait until maybe something changes a little bit and more in favor of the buyer. But yeah, again, it's think of it in terms, and it's a very pragmatic approach initially of where was the form, where was the dealership, where was the asset acquired.
Very good. Time for any more?
We have time for one more. Crystal ball, what is the forecast for refinancing?
Ooh. It's going up. Right? I think, what was it, John? Was the Fed going to maybe be targeting another 25 basis points cut here? Maybe 50 by the end of the year?
There's a lot of rumors running around.
Yeah.
Some of them are saying, yep, 25 points for the next 6 sessions, right?
That's a lot.
Through the end of 2026.
That's a lot.
I think alternatively, what's interesting is rates will go down dramatically if we go into a recession.
You brought up the R word.
Yeah, just there's a scale here, right? Both of them will impact rates, but the plan today is quarter of a point, quarter of a point, quarter of a point. And I think we discussed it earlier. If we see that the refinance at the end of 2026, that will create an 83% increase to this number of loans you see in leakage today for refinancing.
I hope that answers that question. There's a lot there. So again, we look forward to seeing you at the upcoming Used Car Week event. Nick and the entire team at Cherokee Media, on behalf of John Elias and the folks here at Allied Solutions, we thank you for tuning in.
Yeah, we appreciate your time. Thank you.
And that's Peter Kroll and John Elias with Allied Solutions. So much great information and recommendations, and you can find more at their website at alliedsolutions.net. We thank you so very much for joining us, and on behalf of all of us at Cherokee Media Group, thank you again for joining us, and we look forward to having you again next time.